Here with me today I have Andy Craig, author, investment manager and founder of Plain English Finance. With his VT, Plain English Finance Global Multi-asset fund up and running for a full year now, we thought it was a great time to find out how things have gone. Well, good afternoon, Andy.
Hi there.
First question, could you give us a brief potted history of Plain English Finance and how it came to be? Who's behind it?
I'll do my best. I'm reliably informed by my wife and everyone else. I'm not very good at brief, but I'll try. So I guess I've been in the city for about 20 years, and in 2010 I quit my then job as a stockbroker, selling equities, and had this idea that I'm going to set up a website that just gave lots of free information to people about finance, because I just perceived that that's something that's been borne out. Financial literacy is really bad, and we all kind of know that, but it's far it's worse even than we do know. So even people with pretty sophisticated jobs as accountants or lawyers or whatever else who you'd think might understand finance, actually when it comes to the nuts and bolts of what is a SIP, what is an ISA, how should I invest in the world, fall down and really don't, the general understanding of stock markets or financial markets, whatever else in the population is really poor. So I had this idea to just produce a website, and I started this website called plainenglishfinance.com back in 2010. After I'd written about something like 100,000 words on the website, being really naive about how people interact with websites, actually my cousin said to me, nobody wants to read 3,000 words on a website and then click to the next page to read another 3,000 words, so why don't you turn this into a book? So quite much, so that became a book called How to Own the World, and it was published in 2012, and randomly suddenly we had 50 5-star reviews on Amazon, and it started selling lots of copies, and all the reviews weren't necessarily written just by my mum and my sister and whoever else. And so that then morphed, it's been a kind of a demand pull rather than a supply push story since then, because basically the book it's now usually in the top 1, 2 or 3 books on personal finance in the UK. And the 3rd edition is coming out in March of next year with Hodder and Stoughton, massive publishers, which is very surreal for me and a lot of work. And then that we basically, as you'd expect, if you've sold quite a few thousand copies of a book, and we've now got 300 reviews or whatever it is on Amazon, lots of people got in touch, and happily, a couple of those people were 2 professors at the Cass Business School, Professors Stephen Thomas and Andrew Clare, who. It's a bit of a longer story there, there's a bit more complicated than that, but by virtue of being able to work with them, and they're sort of preeminent in trend following. Academically, they've written an awful lot of research on trend following and how it works and how it can be applied. And so what they don't know about trend following kind of isn't worth knowing. And my book being called How to Own the World, my whole thesis or shtick, if you like, is that basically there's a 200-year track record that if you own all major asset classes, so not just shares, or not just bonds, or not just gold, or property, or cash, so basically if you own all of them, and you own them in all of the major regions of the world, so that basically means nowadays Asia, the US, and what am I missing? Us, Europe, and I include the UK in that for now, despite what's happening tomorrow. If you own all assets in all areas of the world, you bang out sort of consistent high single-digit, low double-digit returns. And so that's the whole thesis. That's why my book's called How to Own the World. If you can achieve that, and you add that to the sort of Einstein's 8th wonder of the world, compound interest, that over a lifetime of investing, in a really defensive way, with high single-digit, low double-digit returns, but protecting the downside, you can achieve really big numbers. And so that's what my book's about. And happily, by dint of meeting those 2 professors and a few other folk along the way, we were able, just over a year ago, to launch our own investment fund that kind of incorporates all of those ideas. It's a small fund, we've only got £11 million in it at the moment, but these things, as you probably know, take time, and attracting investment into funds, you need to establish yourself and have a track record. So we've now got a 1-year track record, and here we are. Hence why I'm talking to you, happily.
Well, exactly. Yeah. The VT Plain English Finance Global Multi-asset fund is a year old now. So could you tell me a bit more about the fund's objectives?
Yeah. So as outlined, hopefully to a certain extent, in the mouthful of a name. By the way, the name, we wanted to call it the Own the World Fund, but the Financial Conduct Authority said that was misleading. So it's not really, it's a bit of a ridiculous name, but it kind of does what it says on the tin. So, strictly, if you look at the fund prospectus document, it says medium-term capital appreciation with significant downside protection. So in a nutshell, what we're trying to do is invest globally, have a trend following overlay, which I think we'll come on to shortly, and by virtue of that, really peg the downside, and we can talk more about that, but still bang out, hopefully, I mean, the 17-year back-tested numbers that we've done, and we can talk more about the back-testing as well, are sort of producing 7.52% annualised numbers, which over time, there was 4 years that were 20% or more, but very importantly, only 3 years that were negative, one of which was 2008, was only minus 6.6%. So that's a long answer.
Yeah. Well, look, I mean, I guess the question that the investors will ask is how you do it. So, I mean, there are a couple of key investment techniques, and you talk about true diversification and formula-based trend following. I mean, that you use those to achieve the fund's goals. Could you just explain a bit more around those?
Yeah, exactly. So my book being called How to Own the World, I mean, the insight was people like Harvard, Yale, Oxford, Cambridge, you know, the richest and smartest people in the world. For many years, as I said earlier, they basically, if you own all assets in all geographies, there's this, you know, in 2007 through 2009, the S&P 500 halved, the FTSE 100 halved, lots of stock markets did worse than halved, you know, emerging markets and so on and so forth. Very painful. But gold went up 19.5% in 2009 in dollar terms, and in 2008, oil hit an all-time high. Sometimes Japan's a fantastic place to be, you know, sometimes China's great, sometimes LATAM's great. And the insight really, and as I say, sometimes hard assets like gold are great, and sometimes equities are the place to be. So the insight really is that if you, rather than try to work out which one's going to win, if you just own all of them, which we call owning the world, that's your true diversification. So all assets in all regions. Now, my parents or grandparents basically couldn't invest like that. You know, if you were the Rothschild family in 1850, you could. If you were Harvard University in 1950, you could. But if you were a normal person, you couldn't until about 2000, when, you know, inexpensive ETFs and cheap E-Trade accounts, and now great platforms like Hargreaves Lansdown, people today can invest this way. But there was still a slight missing piece of the jigsaw, because if you do that, you will still have years like 2008 where it's carnage, because basically everything falls at the same time. So happily, by meeting the professors, what they layered on top of that was work they've done that goes back to 1872. They've basically gone back as far as they can with each of the major asset classes. And the S&P's existed since 1872, so they've done that analysis for the S&P. But if you put on basic trend following, so for people listening who perhaps don't know what that is, it's actually this idea that humans are basically a herd. We have a pack mentality. So why does trend following work? All trend following does is look at the direction the market's been going in over a certain amount of time. And if the price today is above the average price looking back how many time periods, 200 days, or you could even look back 10 years, or if some high-speed FX traders look back 10 minutes, you know, and compare the price this minute to the, or probably more likely an hour. But if you compare today's price to an average of the last however many time periods, and it's above it, probabilistically, the likelihood is the price will carry on going up. And equally, if the average price is now below that moving average, the probability is the price goes down. Now, our insight and the professor's work says that the best way to use that kind of technique that consistently works over decades, and they've got decades worth of evidence, dare I say centuries, is to take basically a long time period and only trade once a month. So, you know, we're very much the tortoise of investment, not the hare. We're not a super smart hedge fund doing hundreds of thousands of trades every day based on what happened in the last 10 minutes. We're basically looking back almost a whole year essentially and saying, and we're doing it with, so the global trend, the multi-asset bit is, we started with 97 assets that represent the whole world, and the professors did all this work, whittled down to the 80-20 rule. You know, you get 80% of your results from 20% of the effort. And obviously we don't want to run a fund with 97 assets, because that's extremely time-consuming, expensive, administratively difficult to do. So where was, if you like, the Goldilocks place where we had all of the kind of upside and protection of diversification, but without all that hassle? And that we found it was 24. And those 24, most people who know anything about investment could basically tell us what those 24 are, just kind of shooting from the hip. So, you know, the FTSE, the S&P, the Nikkei, gold, energy commodities, bonds, etc., etc. Bit of real estate, bit of infrastructure. So that's a diversification. And on each of those 24 silos, we run a very simple trend following methodology, so that when the S&P, when things start falling, we should very slowly and carefully, like a tortoise, come out of each of them discreetly and into cash.
Well, I mean, the fund, as I say, was launched in September 17. So, I mean, how's it performed versus peers and the benchmark, are you happy with the outcome? I mean, it's been a very sort of odd 12 months, very volatile 12 months for the market, more so over the past couple of months and weeks. So how's it done?
So we're very happy if the fund protects downside in times like this, which the tortoise. It's boring, it's unimpressive, but it doesn't fall 40%. Like an S&P 500 tracker would do in a year like 2008. And then what we hope is that in years where there's a real discernible trend, like a 2009-10 coming out of a big crash, our indicators will get us into the necessary things and we'll have big up years. So since launch, which was September 17, markets have very much been ranging, not trending. So what we've had to endure is those 24 assets. There's nothing that's really powered ahead apart from the S&P, which happily we're still long, but that's only one of 24 of our silos. So we're down, I think in absolute terms, we're basically down 4.5% since launch. Interestingly, relative to let's just take the FTSE All Share, we're basically in line. So if you look at our performance 3 months after launch versus the All Share, I've got them somewhere here, but we were at 3 months, 6 months, 9 months, and 12 months, we were either slightly ahead or slightly behind, and we're now basically level. But the key point here is that in that time we've been significantly less volatile than the FTSE All Share. So the way our fund is designed is if there is a big crash, whenever that comes, 30, 40, 50% over an 12, 18 month period, as is the record of 2000, 2001, 2007, 2009, that we will hope we're still minus 4%, not minus 40%, and then when the bounce comes we'll be back in. The record of the back testing is in 2008-9, through 2008, when the crash was happening, the fund went more than 90% cash, the strategy, and then as the recovery came, it was 45% equities within only 2 or 3 months. So all the signals worked, it goes back in, and so the full year performance in 09 was 21.4% or thereabouts, and so I'm very hopeful that's what we'll do. It's been very boring so far, and obviously, am I delighted? No, I wish we were in a really discernibly trending year and we were up 12, 14, 16 in absolute terms, but as long as it does what it says on the tin, so pegs the downside as best we can and captures upside when the time comes, then basically, I'll be happy. I hope that happens in the next couple of years.
Fewer sleepless nights as well.
Yeah, quite.
Well, look, I mean, you talk about sell signals, and the portfolio is generating more sell signals currently across most equity regions, but interestingly not the US. What's the view? Is it right to ask what's your view on the US market?
No, it's not, and that's what's I joked. I did an interview on Bloomberg Radio not that long ago, and I joked about how I'm probably a rubbish person to interview versus most talking heads, because that's a key thing about what we do. It's not informed by human. It's entirely systematic, entirely rules based. So yes, we're still long the S&P, and we're not long Europe, Japan, Asia Pacific, ex-Japan, or UK. We're out of all of those developed markets. We're out of all emerging markets. We're equities, but we are still on the S&P. Why are we still on the S&P? Because the S&P is still trending beautifully, up, and we can all argue about valuation ratios and is that sustainable and all that good stuff. But we really park that thought process at the door, and we just slavishly follow. Across, and our hope is, and the evidence of a lot, decades of backtesting, not just 3 years of track record, but decades of backtesting, is that by doing that, as I say, you peg the downside, capture the upside. So the signals tell us not to be in a lot of developed market equities, and we pay attention to them and we listen to them. So actually, at the moment, I said we were 90% cash when things went horrible in 08. The strategy was north of 90% cash at the bottom. And we're now 13 of 24 silos are now in cash, which will give you an idea. So the sort of the red light, green light, traffic light is telling that's very indicative of the fact that times are tricky for financial markets.
Absolutely. And again, on similar lines, I mean the portfolio currently, I think, is positioned 45% equities, 30 fixed income, 25 alternatives like commodities and properties. I mean, is that split fixed, or is there flexibility?
Yeah, so the top-down asset allocation that has decided that was based on that. Remember the 97 assets that the professors did all the work on. So they have deep quant skills that I would never claim to have at all, and a really some serious resource there in terms of the people they're working with them. Lots of PhD students, clever folk who can write and really tricky formula in Visual Basic and all that. But you know, having said that, all this is not a black box algorithm. This is just elegant, simple stuff. But to get to the elegant, simple stuff of that asset allocation, that is informed by a really, really deep kind of granular analysis of what's the, you know, should we be 70% extra? If you're going to run this kind of strategy, what's the best way to do it? Now, that's not to say that that is absolutely fixed in tablets of stone. You know, and over time, working with the professors, they are constantly doing the analysis and thinking about whether or not that's the right allocation. But when I tell you that some of their backtesting, as I said earlier, goes back to 1872, our over time is over several years, and again, tortoise versus hare, we will move very, very gradually and slowly. The bigger job that we do to kind of, if you like, justify running the fund, or justify our existence, given it is formulaic and rules-based, is just making extremely sure that of those 24 silos, that we've got the best possible way of, so if we want US equities, all other things being equal, what's the best, cheapest, lowest tracking error way of investing in US equities? At present, it happens to be Vanguard's S&P 500 ETF because it costs 6 basis points, and it's, you know, it's the best S&P 500 product in our opinion. When you get further out to slightly more complicated, more sophisticated things like Eastern European equities or whatever else, they're a bit more expensive, a bit more, as I say, more less liquid, more complicated. Then it's our job to make sure we're using the best ETFs to implement that bit of the silo. And we do that on a much more proactive, you know, monthly, quarterly, we're always thinking about that sort of thing.
And you mentioned use of ETFs to keep costs down. But how does the portfolio work in a falling market when passives might underperform active managers? So
it's funny, remembering back to my first boss when I was a stockbroker at Swiss Bank in the late 90s, I always thought that the idea was that active significantly outperforms passive on the way up. So, you know, you're really smart small cap fund manager like, I don't know, Neil, not less than Neil because he wasn't a small cap, but Harry Nimmo at Standard Life, or Gervais Williams, who was at Gartmore now at Mitre, and all these sorts of, you know, genius small cap fund managers particularly. If small caps were up 15, 20, they'd be up 40, 50, 60, and in the really good years. So you tolerated the years where everyone got smashed by the market, because in the up years you just, you know, do incredibly well. Yeah. So I was always schooled in the fact that you own active because in the up years active outperforms passive. I think things have flipped on their head a bit, which probably informs your question, because Vanguard have accrued more assets under management in the last decade than I think the 9 next biggest investment firms after them, which is BlackRock, Fidelity, you know, these enormous brands. And $4.5 trillion of assets have gone into sort of ETF products basically, and that indiscriminate buying is why the S&P 500 and all the FANG stocks are at the levels they're at. I don't know whether or not that goes into reverse, but I think that for us, as I say, we're really agnostic as to active versus. I mean, I think we might describe ourselves, without it sounds big-headed, as, you know, clever passive. So we're using inexpensive passive, but the moving averages and the trend following overlay is a kind of active layer on top of that. But what is most important to us is protecting the downside, because the break-even fallacy, you know, if you lose 50%, you need to make 100% to get back to zero scratch. So it's actually, for most people psychologically, it's better to make 8.5%, 10%, 7.5% per annum consistently and never fall more than 6, 7, 8, 9, 10% than it is to be up. To go back to that small cap example, even if you get the same result over 20 years of being up 60 and down 40 and up 30, and psychologically you're far more likely to stick to your guns and own something that just is the tortoise, which I've written about at some length.
And then you mentioned break-even fallacy here, but there's a couple of interesting sort of topics: break-even fallacy, sequencing risk, and compounding as well. So some listeners may be aware of, or heard before. Others, they may not have done. Could you briefly explain? You touched on break-even fallacy, but the sequencing and compounding as well.
Well, so I mean, people quite often ask us what type of investor should buy the fund, and my slightly self-serving response is for the subjects, the reasons of the subjects we're about to discuss, is that it could be suitable for for a very wide range of investors. Why is that? Well, let's take the first one. Let's talk about sequencing risk. So sequencing risk, which both the professors have actually done a lot of work on, I think might even claim to have invented the phrase sequencing risk, but I've got to be a bit careful what I say, that might not be true. But sequencing risk is basically, if you're 60 and you've managed happily to get to a point where you've got £500,000 in your pension or £1 million in your pension, after a lifetime of working really hard, if you own things that are volatile, like a FTSE tracker or an S&P tracker, or that small cap fund we talked about, the Standard Life super cunning, clever, special small cap fund that's done so well, in a year like 2008, your £1 million is suddenly 500 grand. If you're 28 and you have 10 grand in your pot because you've been diligently saving since you started your first job, and that same scenario happens, now you've got 5 grand, you've got two things. You've got a lifetime to get, to build that back up, and obviously in absolute terms, 5 grand is a lot less painful than £500,000. So that's sequencing risk. Sequencing risk is the fact that everybody knows this in terms of the sort of lifetime allocation that we all know. 100 minus your age is your equity exposure and all that good stuff that a lot of listeners probably will know about. But so you really, when you're getting to 60 and you've got a significant amount of money in your pot, you need to be aware of sequencing risk, and therefore it should be more appropriate to invest in a product like ours, which explicitly tries to protect the downside, but still can offer you 20% years sometimes. And you don't really care if the tortoise is being very tortoisey and is -3, 0, +3, if you're never -30 and you sometimes are +20. That is, all other things being equal, you'd like to think that's a great product. The other, if you go back to compounding though, the magic of compounding, small numbers become big numbers. Einstein's described it as the 8th wonder of the world. There's a great example that I like to quote, which is if you put 5 grand in a tax-free account the day a child is born and compound at 10% just to keep the maths easy, on the child's 55th birthday they'll have £1 million. It's actually 945 grand, but compound annually. With no further investment, just 5 grand once. People, quite often I say that to, a cab driver on the way home or somebody I meet in a bar, and they look at me like I'm speaking nonsense, but it's the maths work like that. And so the point there is, if compounding is that powerful, the other person that this strategy might be suitable for is actually somebody quite young. Going back to rather than be the person who saw 10 grand become 5 grand, why not be the person who sees their 10 grand in the worst case scenario become 9 grand, but benefit from slow compounding over time? And the reason that's super important is because most people psychologically, again to the pack animal point, we're really, really hardwired as human beings to be rubbish at, if we see something down a lot, greed, fear, we're very highly likely to crystallise that loss. So I quite often cite an example from 2 other professors actually, Elroy Dimpson and Paul Marsh at the London Business School, who have given evidence that going back as far as 1955, it's a great piece of work. UK small caps, again, I like small caps, I used to work at small caps, have done 15-ish% per annum to 1955. So it's very simple, we should all just buy UK small caps, right? Problem is, along the way, UK small caps have fallen by more than a half on something like 4 occasions between 55 and now. Most people, when that happens, panic, sell out at a loss. So actually, psychologically, if you have something that never falls more than, let's just say 8-10%, hopefully 5%, over the same time period, even though probably the 15%-ish from small caps will get you a better result, it'll only get about 5% of people a better result, because 95% of people will have sold out. So you'd be better off in the tortoise, like banging out 6, 7, 8, 9, 10%, but never having a -50 or a -60% year. So that's sequencing risk, compounding, and the break-even fallacy, basically.
Well, look, Andy, it all sounds very compelling, and I wish you all the very best for the next 12 months and beyond. And thanks very much for spending the time with us this afternoon.
Thank you very much for giving me the opportunity. Thanks.